This is our video lecture for chapter number 4, where we're going over the different types of business entities and how they are taxed. Let's take a look at a general overview. Now, in the previous accounting class, you may have talked about a simple type of business like we had done in chapter 1 called a sole or single proprietorship, where we have just one owner. Here we'll have this owner be an individual like you or me. Again, this is called the sole proprietor. And we would prepare the accounting records summarizing the income or revenue and minusing out the deductions to get that business's net income or net loss. Here I'll call it net profit. And we had learned that in chapter 1, this information for the business is prepared on a tax form called a Schedule C. And if our owner up here is going to file a form 1040 and combine with the other income of our taxpayer, include this net profit on that 1040 form and pay, of course, the income taxes. Another type of business entity we'll see more so at later on in a future chapter is a partnership. And with a partnership, you have to have at least 2 partners. So again, let's have just individual partners, just 2. Could be more, could be thousands of partners. And here's our partnership here. And again, the partnership, like any other business, would do the accounting work to keep track of its revenue and expenses or deductions, hopefully coming out with a net income or net profit. We'll see in that future chapter regarding partnerships, this information is filed by the partnership on a form called 1065. And this profit down here has to be reported on the partner's return above. So to communicate that to the partners, we prepare a Schedule K1 for each partner in the partnership. They get a K1 showing how much of this profit has to be included on the partner's probably 1040 form. So our partnership and sole proprietorship do not pay income taxes directly, but the profit of those businesses have to be reported each year on the owner's tax return, and they pay taxes. So down here for sole proprietorship and partnership, these are non-paying income tax entities. Now the tax entity we do learn about during the semester, and here starting off in chapter 4, that pays taxes is a corporation, specifically called a C-type corporation. And again, we track our revenue, minusing out the deductions for the year to get our taxable income. And now we apply a tax rate. For 2018, the new flat tax rate is 21%. It used to be a bunch of different rates, but in 2018, for the whole year, it's just 21%. And you would pay this to the government. Now, our corporation is going to be owned by, again, let's keep it simple, individuals like you and me, called a shareholder. And you can have one, at least one, or thousands, or in theory, millions of shareholders. But this profit down here is not reported directly on the individual's tax return. Only when the corporation declares and distributes profits to the shareholder. Remember, we call that dividends, reported to the shareholder on a form called 1099 DIV. Only now the shareholder is going to pay taxes on the profits that the corporation had earned. But keep in mind, this profit here is being taxed twice. Once at the entity level, and now as a dividend, probably at low rates like 0, 15, 20% we've learned in past chapters. Again, at the shareholder level, that's double taxation. Another type of business entity that you hear about a lot, more common than other types probably, is a limited liability company. And if the limited liability company just has one owner, for tax purposes, generally we treat that LLC as a sole proprietorship with one owner. If you have two or more owners, then that limited liability company is treated by default as a partnership. Okay, and you follow the same rules for sole proprietorship for one owner and partnership for two or more owners when you're a limited liability company. Now, a limited liability company and probably some types of other entities, which we may see in this chapter, can elect to be treated as a corporation, okay, and pay taxes on their profits. Let me also point out, if you're a corporation, you can choose to be another type besides a C type that pays taxes, but an S type corporation or a subchapter S corporation, where the rules are almost like a partnership, where the corporation, the S corporation, does not pay taxes on the profits, but they issue out again K1s just like the partnership. So the shareholders up here have to report their share of the corporation's profits. Now, the main non-tax reason why a owner would choose different types of business entities is to try to limit the liability exposure to those owners. And the main way you do that is to run your business through a corporation or that LLC I just mentioned. And if there is a business liability, the creditors generally can only go after the assets in the corporation or LLC. Now, if you run your business in a partnership or sole proprietorship, generally business creditors can go after the assets in the business and also go after the owner, whatever assets they own individually. So you can see if you have a risky type business, you probably want to use one of these two types of entities. Generally, you want to also get insurance, be it for liability or omission or errors or malpractice insurance, but the entity itself may help you deflect some liability. Again, anyone can sue anyone else, yeah, for whatever cause. But again, you try to protect yourself and other things you own and your family members by possibly choosing a good type of entity for your business. So again, we have corporations, LLCs. The difference between a general and limited partner is that all the partners in a general partnership are liable for whatever business liabilities there are in the partnership. Whereas in the case of a limited liability, by law, usually you need to have at least one of the partners in a limited partnership to be a general partner. And the rest of the partners in the LP can be limited partners. So the general partner can lose his or her investment plus whatever they own personally. Whereas limited partners, the most you can use, usually, again, it can be sued by anyone for anything. Usually limited partners are exposed only to what they invest into that limited partnership. Sole proprietors, just like a general partner, they could lose everything if something goes wrong in the business. Also keep in mind, corporate and LLCs don't protect you from you committing a crime, a felony, a personal tort. You can have been sued for, again, anything. But again, what we're trying to do here is maybe, and it's a legal question, you should use an attorney to get their opinion, which type of entity will reduce your exposure for business liabilities. So where do you go in Hawaii to pick and register the type of business entity you want? In most other states, they call that the Department of State. Here in Hawaii, it's called the Department of Commerce and Consumer Affairs, specifically their Business Registration Division. And you can actually go online and register your business. There's some other links I have in the Laulima site, the resources folder, that show you the different types of, almost 20 different types of business entities that can be registered. Also keep in mind there are other filings with the government besides registering your business entity. For example, everyone in Hawaii or does business in Hawaii probably need to get a general excise tax license. You know that 4 or 4.5% you have to pay on your gross Hawaii business income. That's gotten through the Hawaii Department of Taxation. Another department here for the Department of Commerce and Consumer Affairs is their licensing division. For example, as a CPA, I need to get a CPA license. And whoever runs a business, an office as a CPA, you probably need a permit to practice. So all of this type of registration is done by, again, the Department of Commerce and Consumer Affairs in their licensing division. Other types of businesses that need specific professional licenses are architects, doctors, even plumbers, hairdressers, hairstylists. They all need to get a license to do business here in Hawaii. If you have employees working for you, you need to apply for an employee uh, identification number, and the place you go for that is with the IRS. Non-tax, again, reasons for choosing a business entity. We saw corporations and LLCs will limit the liability of the owners, whereas the other types you have more exposure. So now the tax reasons for picking different types of business entities. Remember, most times you want to avoid that double taxation, once at the corporation level and again at the shareholder level. So those other types of entities, sole proprietorship, LLCs, partnerships, get taxed only at the owner level. Now, if for whatever reason you want your non-taxable entity, sometimes we call that flow-through because the income flows to the owners. If you want your flow-through entity to be taxed as a corporation, you can elect to do that by using something called check-the-box regulations. It's really a tax form. Here, this one called 8832, where you can pick to be a corporation, taxed as a corporation. But by default, most non-corporate entities are taxed or report as a flow-through entity. Now, this one mentions here the C-type, yeah? The C-type pays taxes. But even if you're a corporation, you can elect with the IRS, not with that Department of Commerce and Consumer Affairs, but the IRS, to be an S-type corporation. And you have to pass your income to the owners. So that's done by filing with the IRS this form 2553. Okay, you have to make sure you do that timely for the year you want to become an S-type corporation. And we'll see that S-type corporation in more detail as the last chapter of our semester. So non-corporate business type entities. For a partnership, you have to have more than one owner. For a sole proprietorship, only one owner. Now you can have many employees working for you, but here only one owner, not a corporation. And you cannot hire yourself, right, as a sole proprietor. Now you could hire family members and be treating them as employees, but they're not owners. Unless you make them so, now you would have a partnership. And again, an S corporation would be more like a partnership, whereas a C type will pay taxes. Taxation of business entity income, again, the C type will pay taxes. And if you have excess profits that you want to share with your owners, the shareholders, then they'll pay a tax when they receive those dividends. In the case of the other type, the unincorporated entities, you can distribute almost any amount of money to them generally, and they would not pay any taxes because they are going to report all of the income for the year on their own owner's return, be they take out nothing or everything or more than everything. When you choose the type of entity you want, consideration is what tax rate is the income going to be taxed at the owner level versus at the entity. In our case, it's always going to be a C-type corporation, the tax rate for the C corporation. Here, we're going to assume, and also in your homework, that the rate we work with at the owner who's an individual is going to be the maximum 37% tax rate. In real life, in real planning, you should consider that this 37% is for income above, in the case of married filing joint people, above 400,000. And you can see in this tax rate schedule, the first 19,000 of income is taxed at 10%, and the next range of income is taxed at 12%. But to keep things simple, including the homework assignment, I believe we just assume all of the income is taxed at the highest marginal rate of our taxpayer. Another type of income tax that's tacked on to that 37% tax rate is for what we call net investment income. The Affordable Care Act, or Obamacare, needed to have additional funding when it was first implemented a few years ago. So one additional tax that was created is this net investment income tax that subjects high income taxpayers to a 3.8% tax rate, not on all of their income, but investment income. So let me show you a short part of the form here. Oh, and also keep in mind, all of your income as a Hawaii resident is subject to Hawaii income tax rates that has the highest rate marginal rate of 11%. It's very easy to get into high rates here, especially this 8.25. The married filing joint is further down here for 8.25, but that's usually the most highest rate most taxpayers get into. Here is the form for the net investment income tax. So things like interest, dividends, certain annuities, rental property, all of that income, and certain gains are subject to that 3.8% rate. If their income goes over a certain limit, that's further disclosed down on this form. Okay, so that's this tax. Another tax that is tacked on to the income tax is for self-employed taxpayers, like we had learned back in chapter 1. And because they don't have any employer above them to withhold and pay Social Security taxes, self-employed taxpayers have to pay self-employment tax on their own. that can go up to a rate of this 15.3%. So let's take a look at the form to report that. Here a Schedule SE. And you don't see any calculations here, but let me kind of go through some of the calculations. Most of us can appreciate the viewpoint of an employee where we have taxes withheld. So one of those taxes is a 6.2% Social Security tax. You know, when you get to retire, you can start maybe hopefully collecting that. But they also take out another 1.45% for your Medicare. So when you're 65, I think it's 65, you can get that hospital insurance and maybe pay a little bit more to get that additional doctor's insurance. So the total they take out for this type of taxes, this 7.65%, I believe they call that FICA, Federal Insurance Contribution Act tax. Now keeping in mind this 7.65 is half the tax. The employer who you work for will match it, 6.2 for Social Security, another 1.45 for Medicare, for another 7.65%. So the total FICA taxes being paid is 15.3%. This is on the first $128,400 of wages or salaries for 2018. Once you make over this amount, only this tax will then apply, the Medicare tax. For 2019, the limit, the threshold is 132,900. They're thinking of eliminating the threshold, this 6.2% amount subject to the wages, to help fund Social Security for future years. But that's still maybe in the works. So if you're self-employed, you don't get to have this taxes paid by anyone because you're not an employee. You're self-employed and you gotta pay this on your own. So you're gonna take your business profit from your Schedule C, and the IRS gives you a break. They don't tax the whole thing. They're gonna bring it down to 93.25%. I think they're reducing 100% by maybe either the employer or employee share. Okay, you multiply the two, and it's this amount that's subject to now 15.3%. And they call this not FICA, not Social Security tax, but self-employment tax. This is in addition to your income tax. So this is a big hit for a lot of small businesses. And there's some more, this is general rules, and there's more defined rules on the Schedule SE. The tax is so big, the government gives a break by allowing half of their self-employment tax to be a deduction, so-called adjustment to AGI. So one more tax that's tacked on here, and that's this additional tax to help fund Obamacare. We saw that the Medicare tax and Social Security tax were taxing work income. Now, additional tax on this work or earned income is almost 1% more on your wage or salary above a certain limit. The employer has to withhold this 0.1%. Or again, if you're self-employed, no one's withholding taxes, so that has to be tacked on. In either case, as an employee or self-employed taxpayer, if your income goes beyond a certain limit, you have to fill out this form here. Here, wages or self-employment income above a certain threshold. Here's part of it for this wages, and additional amounts for self-employed below, subject to that 0.9% more Medicare tax. So all of these taxes have to be considered when you're deciding what type of business entity to choose to run your business. Okay, this is the end of the part one. So continue into part two video lecture for chapter number 4.